Hit it.
It's Friday, June 25th, 2021, episode 137. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show yellow metal entrepreneur Amir Adnani. We get Amir's take on royalties and why gold and uranium are at the top of his list for attractive investments. Then, in Talking Charts, the Lord of the Crayons brings us up to speed on what the technicals might be telling us.
And this week in trading history, we go back to the creation of the continental currency. We end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking today?
Today, we're drinking Dewclaw Brewing Company's Dirty Little Freak Coconut Caramel Chocolate Brown Ale.
Well, you know what's funny here? I'm trying to twist off this bottle, and it's not twist off. And so, I'm like, oh, I want to try this beer, and I can't. Okay, guys, we're gonna have to pause here for a second while I get a bottle opener.
Well, let me read this then.
All right.
Dirty Little Freak Coconut Caramel Chocolate Brown Ale, first brewed in 2014, takes the traditional American brown ale and gives it a sensual new twist: coconut. This medium-bodied brown ale is a feast for the senses from its dominant blend of warm, roasted malt, coconut, caramel, and chocolate flavors barely restrained by a gentle hop bite to its tantalizingly satisfying finish.
So I have to come clean here. It's Kevin, and I'm actually been out of town. We went on our first little mini vacation in a long time, and I left the beer at home. And actually, now that I hear the description, you might think that I did that on purpose.
No, I didn't hear the description, so I'm about to taste whatever you guys described when I'm back here. Let's try this.
Okay, well, what do you think?
Oh my!
We're going to leave the rating until the
my
very
God.
end.
Anyway,
Okay.
I have to do a shout out. Thank you for Anastasia for sending in these beers, but that tastes like shit. It really does. This is an awful beer.
I'm really upset I missed it. And actually, before we continue, I want to give a little bit of a shout out to one of the funniest guys on Twitter. I did not come up with Lord of the Crayons. That is actually Horse Fat Lover, who I think is one of the he's one of the funniest guys on Twitter, and I've convinced him to come on the show. Make sure you guys tune in; it's going to be a lot of fun. But Lord of the Crayons is completely his moniker that he came up with, and it's terrific. And I thought it would suited Patrick perfectly, so I've adopted it for Patrick. Lord of the Crayons. Okay, let me do the side effects.
Disclaimer, yeah.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Vicks tranquilizations, OTC odors, or the candlestick burns.
I've suffered candlestick burns, but I didn't know that was a thing. Anyway, so
let's get on to an interview with Amir.
I have the pleasure to welcome Amir Adnani, chairman and founder of Gold Mining Inc., Uranium Energy Corp., Uranium Royalty Corp., and Gold Royalty Corp. Welcome to the show, Amir.
What an introduction. Thank you. Too many companies to cover, right?
Exactly. Now, I had the opportunity to meet you a number of times in person at the different resource conferences out west. So it's great to finally get you on the show to talk some gold and uranium. But before we get to the meat of the conversation, I wanted to start by asking a bit about your backstory. Where did you grow up? Where did you go to school? And how did you get into this mining business?
I grew up in North America between Bellevue, Washington, Pacific Northwest, and then my family moved over to Vancouver, Canada. So I've been in the Pacific Northwest most of my life. And for people that may not be familiar, Vancouver is really the epicenter of the resource business globally. There are more junior resource companies and some big ones that are based here than any other city in the world. And as a result, really from a young age, like when I graduated from the University of British Columbia, came out, I got involved right away in starting a number of resource-related businesses, and ultimately fell in love with the opportunity set with the two yellow metals, gold and uranium. They have absolutely very different dynamics, needs, applications, but ultimately that has brought me down this path with initially Uranium Energy Corp and gold mining, and then I fell in love with the royalty business and really developed the two royalty companies that you mentioned, Uranium Royalty Corp, which is the first of its kind, the only dedicated uranium royalty company in the world, and then Gold Royalty Corp, which I launched earlier this year.
Right. So let's talk about this for a moment, because I want to talk directly about your companies in a moment, but I wanted to start a little bit higher level in the perspective of a lot of our listeners that look at gold and uranium. They look at it in a binary way of either I want to invest in them or I don't want to. But there's often a lack of clarity in helping make the decision as to whether to invest through the miners that extract the commodity or the royalty companies that help finance them. So can you just take a moment to kind of differentiate to our listeners the considerations that they should take into account when deciding whether to invest into mining or royalty business?
Yeah, for sure. I mean, when you think about the mining business, probably the greatest degree of risk reward is sort of the spectrum we need to look through all of this. So from a risk reward point of view, if you invest, let's say, in a very early stage company only doing exploration, that offers the highest potential reward, but also the highest risk. But basically, odds are the same as going to the casino or Las Vegas and gambling. You're talking about 1 in 10,000 prospects becoming a mine. And so when you're in that early stage, looking to put in early stage drill holes, potentially finding mineralization, that's one end of the spectrum. And the other end of the spectrum are companies that have found the deposit, commercialized it, put it into production, and are producing the commodity, be it gold, be it uranium, and generating free cash flow. Less risk involved, but at the same time, you're not going to get the same kind of outsized returns. The royalty business kind of straddles an interesting, almost introduces a new vector to the spectrum that I just mentioned to you right now, in the sense that royalty companies don't take on any capex or capital requirements or ongoing investments or any of the work associated with looking for the commodity or mining the commodity. Royalty companies basically are a portfolio, a collection of agreements with companies that own the projects, that over the life of mine, when they start producing from that mine, a percentage of their revenue goes to the royalty company. So really, the royalty company is this holder of these agreements, and these agreements pay. The royalty is really an agreement, right? And it pays, let's say, 1 to 5 to 10%. Everyone differs, right? Of the gross revenue. Now, that's a very interesting value proposition when you think about it. So if you're a royalty owner, you get to basically share in on the upside. You get commodity price upside exposure. You get exploration upside exposure. If things go really well, you get all of that exposure. If things go wrong, you're not on the hook. You're not committing capital continuously. And mining is one of the most capital intensive businesses in the world. And so as a result, the royalty companies have become a very popular way for generalist investors to get exposure to the mining industry, mainly because of this risk reward kind of setup that they offer. And the valuations reflect that, where you would typically see a mining company trade at 1 to 1.5 times. A multiple commonly used in mining would be the price to NAV, so the price trading in the market relative to what the underlying net asset valuation is. The miners would trade at 1 to 1.5 times NAV, whereas the royalty companies can get to 2 to 3 times net asset value. And so the superior aspect of the business model is reflected in better multiples that the royalty companies can garner.
Right. And and the question that I'd have, and maybe I'm asking naively, but ultimately, when these royalty companies are often you're reinvesting all the proceeds that are coming in to buy more royalties. But is the goal of a royalty company ultimately to start paying that out as dividends down the road?
Yeah, absolutely. Any successful royalty company would eventually pay a dividend. Royalty companies also are meant to be extremely small and nimble, in that they have very small general and administrative expense. Their overall burn rate to operate that company is small. Why? You only need a small team of financial analysts and technical folks to review these opportunities, these royalty opportunities. You pay for them up front. You acquire the royalty, you park it, and that's really it. You're not going out there again continuously working that project. That's what the mine operator does. Think of it. I've got 3 young kids, right?
Right.
Yeah, and it's a lot like raising kids. It's an interesting way of looking at it. So when you're the parent, right, and you got these kids, you're with them all the time, right? From morning to night. You're responsible for everything, right? And then you got these like grandparents and aunts and uncles, right, who show up on the weekends and just really, enjoy the time for a couple of hours, right? You have a great grand old time on the weekend, and then they leave. And the royalty companies are kind of like those grandparents or aunts and uncles that just come over and hang out for a while, take all the benefit, and then they leave. And then the parents are the ones there constantly, morning to night, just working away at it, which is what the miners are in a way, that own the projects and literally everything from land ownership, stakeholder relationship, permitting, exploration, development, all these elements that go into building a mine, operating a mine, which again is time consuming, capital intensive. It's a fascinating kind of way of looking at it.
All right. Well, let's dive into the two yellow metals or commodities, and let's start by talking a little bit about gold. First of all, before we get into the actual mining side of it, what's your bigger macro outlook on the commodity? Is this still a big bull market in gold that can see it much higher, or is there room for gold to continue pull back? Like, what's your sort of outlook here on bullion at these price levels?
I'm very bullish for the following reasons. First of all, I know everyone likes to start with the economic reasons, the relationship to rates and inflation, but I kind of want to start actually with the physical reasons to be bullish gold. Um, and I don't want to call it peak gold, but we do need to look at gold as the fact that it is a physical asset. It does need to be mined. Before it can be mined, it needs to be found. There has to be exploration and development. And over the last decade, we've seen serious shrinkage in reserves and resources globally. The reserves and resources for major gold producers are at a decade low. If you're a gold producer, you live and die with reserves. Every day that you mine gold out of the ground, you die a little bit because you have that much less gold available for future production, and you got to keep looking for these. It's not, deposits are not just readily available sitting at surface so you can go scoop it up. And so when you talk about a decade of underinvestment, you look at reserves and resource pipelines, the next generation of gold deposits that need to be discovered, that need to be permitted. McKinsey did a very interesting study looking at permitting timelines. Anywhere in the Americas, everything takes longer to permit. It could take up to 10 years to permit projects. The amount of work that a company needs to do to be compliant with environmental, social, and governance responsibility, especially when you're a public company, all of this adds to cost. You add on top of that all the bottleneck issues of the raw materials that goes into mining, which there's a shortage of just about everything in the world right now due to what has happened to supply chains over the last couple of years. It's not going to be easy to continue to replenish the pipelines of reserves and resources, and the next generation of mines, in my opinion, will cost more. And then let's bring inflation into it, not to mention the inflationary pressures driving cost up everywhere across the board. Well, that's going to have an impact on mining. It's a
Right.
it's a circle of kind of this negative circle in a way of that feeds on itself. And mining is one of the first ingredients or first steps in the path towards getting commodities and goods out of the ground and then developing it and using it in our everyday lives. So looking at inflation, I just think we have inflation here with us for the next 2 to 4 years at a minimum. And finally, we have to always look at the relationship to real rates when it comes to gold. And I think clearly things that real rates or the 10-year treasury, when you look at it as another kind of key barometer, isn't as low as it was last year where we saw gold get over $2,000 an ounce. But I think ultimately the inflationary pressures that we see out there, the fact that we're not out of the woods yet entirely with the pandemic and the supply chain issues that we've experienced. All of this really points towards probably $1,900 to $2,000 an ounce gold towards the end of this year. But I think we're going to see gold back over $2,000 an ounce going into next year and the year after that.
Well, that could certainly be a great tailwind. I mean, the real yields, everyone seems to be making, a big deal about these kind of 10 basis point swings. But, I mean, real yields remain incredibly negative, and the prospect of them turning positive is something I still think is quite a bit far out. So I think it's just probably noise on that front. But anyway, now you founded Gold Mining Inc., but you also started your newest company, Gold Royalty Corp., which started just trading back in March this year and has been doing very well. I mean, just this week we had a really nice pop on the news that, if I pronounce it right, Ely Gold, was that right pronunciation? But yeah, you guys acquired them. What's the story and for Gold Royalty Corp. And why don't you fill us in on the whole story?
Well, as I mentioned earlier, I'm as an entrepreneur, I'm passionate about the opportunities I see in the gold sector. I'm passionate about the opportunities I see in the royalty sector. You combine those two, you bring in some incredibly exceptional people and partners, and that's the background to Gold Royalty Corp. I had really the once in a lifetime opportunity. I mean, you just don't found. It's hard to have a convergence of all these dynamics that we just talked about. A sector that has been depressed for so long, the gold exploration development sector, the rise and the appeal of royalty companies to the investment community, and the ability to partner up with extremely talented and industry leaders when it comes to the gold sector. So Ian Telfer and David Garofalo, who were respectively chairman and CEO of Goldcorp, one of the major gold producers in the world, in 2019 merged with the biggest gold producer in the world, Newmont, and the biggest M&A transaction in the history of the gold sector. It was, which is what created Newmont as the largest gold producer in the world today. And these individuals, as a result of that transaction, David and Ian were, in a way, free agents. And you think about, the ability to any day of the week, you can team up with LeBron James or a superstar in a respective field to build a new opportunity in business. Those are exciting moments and challenges, and that's what we kind of really took advantage of. I had built gold mining over the last decade to acquire a suite of very large gold resources and gold projects, and we spun out of gold mining royalties on those assets and created Gold Royalty Corp. with David and Ian and a number of other key individuals. Warren Gilman, who manages investments for Li Ka-shing in Hong Kong. We brought in John Griffith, who ran mining investment banking for Merrill Lynch Bank of America. So real star power, just a first-class team. And the opportunity we looked at was to enter what we think is actually a very congested space when it comes to royalty companies. Lots of other people have noticed that royalties are doing well, and lots of royalty companies have been created over the last few years. And we saw that as a consolidation opportunity, especially coming in with a first-rated team, a big portfolio behind us. We had a very successful IPO just a few months ago, raising $90 million, listing on the New York Stock Exchange. We came out of the gate, stock trading at about $4.50, and we announced our first acquisition this past week, acquiring Ely, as you mentioned, Ely Royalties. And the market really likes the deal. Our stock has gone as high as $7 a share this past week on the back of this news, came back and consolidated around $6 a share right now. So it's a nice, really nice move for our IPO investors. But this is exactly what our IPO investors wanted to see from us. Get out there with the team that we have and start rolling up and do consolidations in the gold royalty space. Well, look at how attractive the deal that we done is. We started life, we had 20 royalties. With this acquisition, we gained another 80, takes us to 100 royalties for across the Americas. At least 4 of these royalties that we're acquiring are generating free cash flow, and that cash flow is going to grow quite a bit over the last few years. We diversified our counterparty portfolio, number of various producers that we have as counterparties now. Eric Sprott, who's one of the biggest names in precious metal investing. He was the biggest shareholder of Ellie. He's locked up and is supporting this transaction. So when this deal closes, we'll have almost a 500 million market cap company, New York Stock Exchange listed. Gold Mining would be the largest shareholder. Eric Sprott will be the second largest shareholder. You have 100 royalties, no debt, and free cash flow with a total of probably less than 10 employees. This is just this is what people like about the royalty business, right? And I think here, what the markets rewarded us this week, and with the share price trading up, as much as 50%, it's because they recognize if we can execute on getting bigger through acquisitions, just like what we did here this past week with Valley, we can seriously create one of the exciting new royalty companies out there, and very quickly, just become a very meaningful size player. So this deal has to close in the next 60 days. We're on the right track to do that. And it just shows, Patrick, that when you get out there as an entrepreneur, where you got the right people together and you execute, it gets rewarded by the market. What else can you ask for?
Well, it is interesting to note, a lot of people have a hard time differentiating between the royalty companies and gold miners. But if you go and, let's say, look at the history of a Franco-Nevada during the gold bear market between 2011 to 2020, the gold royalty companies were rallying while there was an extensive bear market in the miners. And so often there's a resiliency. Even just the last couple of weeks, a lot of these gold royalty companies are still holding up while the miners are weak in the recent reaction to the FOMC. Anyway, let's move on to talk some uranium, the other yellow commodity there. And so what I wanted to touch on here, just to get some perspective on this uranium price, where we are, and this almost decade-long bear market. So uranium, I think, remains still trading under the cost of production, but there's an old truism of the cure for low prices is low prices, and there have been a lot of mine closures and many producers buying uranium in the open market. I think some of your companies have been doing that as well, right? Is the market finally working through this excess supply? I mean, are we going to start seeing uranium move towards the cost of production, where some of these mines will start operating again?
It has to, and as the other old saying goes, the uranium price is going to have to go up, or the lights are going to go out, and the lights aren't going to go out. The demand for electricity over the next 20 to 30 years is going to more than double. We're talking about incredible big trends here. You're talking about population growth, and population growth drives increasing demand for electricity. You layer on top of that the importance of meeting our energy needs, meeting the needs of greater electricity output in an emission-free or clean manner, clean energy, green energy. That's really the name of the game. And so if you look at the fact that renewables simply can't carry the weight on their own, simply don't have enough critical mass to displace some of the carbon sources of electricity generation, nuclear enters the realm as being really the friend and the very key part of the solution a friendship with renewables is the friendship I'm talking about, and being a very part of the mix. So if you're a policymaker, if you're a climate scientist, you're embracing nuclear power right now like we've never seen before, because you see these incredible qualities that nuclear power has. So nuclear power is going to grow. As it grows, to meet the increasing needs for clean electricity, we need more uranium. Uranium is the fuel for nuclear power and nuclear reactors. It's as simple as that. It's a depleting commodity. You pull it out of the ground, you put it in a reactor, you generate electricity for 12 months, and then you need to reload again. It doesn't get more straightforward than that from a supply-demand point of view for any commodity, as simple as it is for uranium. And the bottom line is that that most uranium mines in the world today can't make money at today's uranium price. There was excess inventories in the world ever since, over the last decade. And that excess inventory is being chewed through. Large mines have been shut down, which is a great indicator of the fact that prices are too low. And so when you look ahead in the coming decades, there needs to be probably at least the doubling, and I would argue even more, of the uranium price to incentivize new production coming online. We're at about $30 a pound right now. Incentive price to bring new mines online is going to be north of $50 per pound, so $50 to $60. Add on top of that, again, inflationary pressures that are out there when it comes to any large-scale project development, such as mining, such as building a uranium mine. And so I think we're going to see an environment where uranium prices return to their 2010 highs of $70 per pound. And there's arguably an environment that takes the uranium price to its 2007 highs of $140 per pound. At any one of those scenarios, $70 or $140 per pound, it doesn't make any difference to the bottom line, or it makes a very small difference, a negligible difference to the bottom line of an end user, the power plant, the reactor, whether they're paying 30, 70, or $140 per pound, because uranium makes up less than 5% of the total cost to generate electricity. But you got to have it. If you don't have it, you got to shut down an entire nuclear power plant, because it can't run on zinc, lead, or silver. It's got to run on a uranium-based nuclear fuel. And so you're not going to go through all the trouble and expense. It's way more costly to shut down a nuclear power plant than it is paying more for a pound of uranium. And that's why in previous cycles, we have seen uranium prices rise to over $100 a pound, and see utilities, the end users, sign contracts, long-term contracts at those prices. And that's why at the end of the day, you still don't see a major bump or any kind of noticeable bump in your electricity bill when that has happened. I don't recall ever reading an article in the New York Times about consumer electrical bills going up in the Northeast or in Illinois, or where all the nuclear power plants are, because the uranium price went up. And that's because it doesn't make a noticeable difference in the bottom line. And that's a big thing, Patrick. You look at natural gas-fired power plants, 70% of the cost to run those power plants comes from just the cost of natural gas. There's so much more variability involved in terms of where the price of the fuel is with those types of power generation sources. And you still have emissions on top of that, which is a whole other cost. And it's a cost to our world and to our environment that big funds and on a daily basis, more and more consumers don't want to incur.
Right. So I'm going to just, I wouldn't mind getting your perspective, because I've heard the argument out there that there is actually no shortage of uranium. An example would be that next gen deposit and these other ones, and that as soon as the price starts rising to that economic level, that there is going to be plenty of supply available. What am I missing, or when I hear that story, what's your perspective on that?
Well, it's just not, I don't want to say it's not true. In the sense that, I mean, yes, there is NextGen, and they have a deposit that they're developing. But let's just step back for 1 second. We got to look at supply demand. Demand for uranium on an annual basis, it's approaching 200 million pounds. Supply of uranium from mining today is approximately 130 million pounds. And so every year we're chewing through a whole lot of above ground inventories, which is why those are dwindling. Now, you talk about deposits that are currently operating. You look at a Cigar Lake, which is equivalent in size to the deposit that, or the type of annual production it can have. The next gen deposit you mentioned is similar to a project like Cigar Lake. Well, Cigar Lake, currently producing, has an end of mine life in the next 8 to 10 years. So in 8 to 10 years, as a new deposit comes on board, a big one like what you mentioned, like that Arrow deposit, that'll replace Cigar Lake. Then what?
Right.
Where is the next big deposit that can have that can move the needle like that? And the big deposits that are currently in development, none of them are fully permitted. None of them have broken ground to start production. And so the point that I come back to is that the reality about uranium mining is that uranium mining is one of the most permit-intensive businesses in the world after aerospace and defense. It's more permit-intensive to permit a uranium mine than a gold or copper mine. And so when you look at the fact that most uranium deposits in the world today are at a pre-permitted stage, they haven't even broken ground on construction, they don't even have permits yet, the response time isn't going to be that simple or straightforward. I don't know why anyone would just say there's a lot of uranium out there. Show me which deposits are fully permitted. Show me
That's a
which
good point.
deposits are under construction right now. The answer is no to the first one and none to the second one. And so, is there a lot of uranium out there? Sure, yeah, but you got to think realistically about what it takes to permit, build, especially with the kind of very stringent permit requirements that we have in Canada, in North America, in the U.S., and Australia, and considering that most of the uranium in the world comes from Kazakhstan right now. 40% of global production is coming from Kazakhstan. They're like a single nation OPEC. There's not going to be a lot of appetite to see Kazakhstan go from 40% of global production to 80% of global production. That's just too much concentration, and it comes with risk. And so utility and end users are going to want to see more geographic diversification. And when you think about geographic diversification, you need to see more production come out of Western countries. U.S. comes right at the top of that list. The U.S. is the largest consumer of uranium in the world. Yet there's no uranium mining in the US. There's only one mine operating in Canada. And so, from a supply chain point of view, is that reasonable? Is that safe? Is it logical that the world's biggest uranium consumer, the US, should be so dependent on production from Russia, Kazakhstan, and Uzbekistan? This just doesn't make sense. And so, then you ask yourself, well, how easy is it to permit a uranium mine in the US? I'm a good person to answer that because I've permitted my company, Uranium Energy. We've permitted 4 uranium mines in the U.S., in Texas and Wyoming. I don't think anyone has permitted more uranium mines in the U.S. in the last decade than I have or my company has. It took us 7 years in a permit-easy, business-friendly state like Wyoming, where Bill Gates and Warren Buffett have announced recently they're going to build a small modular reactor there, a nuclear power plant. And Texas, think about it. Like, does it get any more business friendly and energy friendly than Texas and Wyoming? And it still took us 7 years to permit uranium mines. Okay, so that's what we're up against. And there's abundance of most minerals in the Earth's crust, but with mining, you got to have enough concentrations and higher, enough grades and concentrations of any commodity to be able to mine it. And you got to make sure it's not in someone's backyard that doesn't want that commodity. So many boxes have to check before you can actually pull this out of the ground, be it uranium or gold.
Right, right. So, speaking of uranium prices, obviously some of these holders, like the Uranium Participation Unit, which recently Sprott was acquiring, do you think that acquisition changes the market? Do you feel that this is a game changer in any way?
Yeah, it really is, because Sprott has demonstrated an ability as an asset manager specialized in commodities. You look at their Sprott physical gold and silver and some of the other commodities that they have, and they've turned these funds into multi-billion-dollar businesses. And as an asset manager, they're specialized in this. This specialization and skill set is now being brought to the uranium sector for the first time. And if they do what they've done with their physical gold and silver funds, if they do what they've done there with this uranium participation as a physical uranium fund, then you're going to see a whole new dedicated buyer in a very tightly traded physical uranium market. And that could basically really provide competition on the bid for utilities. And it could really create a much more dynamic kind of environment in the uranium marketplace and create that upward pressure, which ultimately could be reminiscent to what happened in 06 and 07, where you had hedge funds start to accumulate physical uranium for their own accounts. And that really drove the market. And we're seeing early signs of that. Just the other day, there was a Wall Street Journal report talking about Anchorage Capital out of New York, a massive $20 billion fund that has now quietly purchased a few million pounds of uranium. You got the Sprott takeover of uranium participation, bringing their skill set as an asset manager to the physical uranium market. These are very reminiscent. I mean, from my experience back in 05, 06, it was so similar, Patrick. We had this long bear market that had taken place from kind of mid-90s all the way to 2005. No one cared about the uranium sector. It was small and forgotten. And then all of a sudden, the hedge funds stepped in. The financial buyers came in. You had depletion of the human capital and resources, and it took a long time for the sector to respond. And one of the wildest bull markets in any commodity was the 06-07 run in the uranium price, when it went from $20 a pound to $140 a pound in a span of a year and a half. The stage is set up for similar type of moves, but in a much more sustainable fashion this time around. Why? Because this time around, emission-free electricity generation is real. You look at what is happening to oil and gas companies out there. You look at what happened to Exxon recently and the Engine One move to get their board members on there. This stuff wasn't happening back in 05, 06. There's a whole movement right now. It's almost like we woke up and there was a Cambrian explosion that took place, and ESG investing and everything that goes with it is so real, and it provides a much different underpinning and long-term sustainable support that creates demand for nuclear power and hence uranium to fuel these nuclear reactors. And we've just never seen a growth like this before. We've never seen a backdrop like this before. And we've never seen this kind of potential transition before away from fossil fuels towards new technologies. And nuclear power is a heck of a technology. It is the only hope out there as a large-scale technology to create electricity on a large-scale baseload manner. Baseload manner means continuous around the clock. And that's why Bill Gates is investing in building a reactor. That's why he's teamed up with Warren Buffett. That's why they're doing it in Wyoming, a classic state of historically coal mining and coal bed methane production, all these hydrocarbons that have come out of Wyoming. And what is the state doing? Welcoming this investment by Buffett and Gates to build a new small modular reactor there, which is, by the way, a whole promising area for nuclear power, or this next generation of nuclear reactors that are smaller, safer, more nimble, and less costly to deploy.
Right. So now you started Uranium Royalty Corp. Now, first of all, like fundamentally, the royalties in uranium are going to have the similar characteristics as in the gold space, but seems a relatively a newer thing. Like, what is it that investors need to know about investing into uranium royalties and how it's slightly different, if it is different at all?
The concept is exactly the same. We're acquiring contracts, which is what the royalty agreements are, on various deposits and assets. We have a portfolio of these royalties. Each royalty comes with a separate counterparty, which is the miner or owner of each deposit that we have a royalty on. We are very diversified geographically by project. We also own physical uranium in Uranium Royalty Corp. And so we have the physical uranium exposure. We have what is left on there now is 8 years. We had originally had a 10-year supply agreement with Kazatomprom, the world's largest uranium miner, and we have a 10-year supply agreement with them to buy physical uranium from them. What we have going with Uranium Royalty is truly an amazing opportunity because really we have no competition. We're implementing the royalty business model that has been proven in the precious metal sector to be a superior way of investing in commodities, in gold and silver. We're bringing that for the first time. No one's ever done this. There's never been a dedicated, pure play uranium royalty company. We're the first of its kind. We are the only publicly traded uranium royalty company in the world. And we've already gone out there executing on the business model. We're listed on the NASDAQ. We've acquired royalties on some of the best uranium mines in the world. Cameco's Cigar Lake that we just talked about, and MacArthur River Mine that when in production could be 20% of global production. We have royalty exposure on those assets. Royalties on projects in the US, in Africa. Again, as a royalty company, you want to be diversified. And really, this business is still very young. We started it just a few years ago, but we've made tremendous progress. And we've IPO'd the company, Patrick, at $1.20.
And what a run!
And it's been as high as $4 earlier this year. So it's up 300 to 400%. It's been one of the best performing uranium stocks. And you would expect that in a better uranium market, an improving uranium market. This should trade at a premium valuation, just like the precious metal royalty companies. trade at a premium valuation. But don't discount what the miners and developers can do. You look at Uranium Energy Corp, the company that I'm the CEO of and founded over 15 years ago. You look at that year over year, we're up over 200%. We've gone from a company a year ago that was just trading about $1 a share. We've been as high as $3 and $3.50 a share this year. We've accumulated and have over $110 million of cash and physical uranium and equity holdings. And I really believe in this idea of buying physical uranium for the balance sheet. This aligns us with our investors much better. Our investors want that uranium exposure. We believe it's one of the most undervalued asset classes in the world. And so instead of just holding on to cash on our balance sheet, we're going to hold on to uranium on our balance sheet. And as that uranium appreciates in value, which is the whole thesis of our business, you have a current asset that's appreciating. It's as good as cash. And gives you the ability to accelerate your cash flows. At $50, $60 uranium, you can sell from an existing inventory position on hand. And so, there really is, like, in a world today, right, where the stock market is at an all-time high, S&P 500, all-time high, Dow Jones, all-time high, inflation in just about everywhere you look, real estate, everything is simply at an all-time high. Uranium is one of the only asset classes that is actually used for something useful. You're going to use it and you're going to generate electricity. And then there's a whole lot of stuff you can do with that electricity, including mining Bitcoin. But that's how useful uranium is. And it's trading at more than half of its 10-year price. It's trading at less than marginal cost of production. It's trading at less than incentive prices. That to me presents incredible kind of risk reward profile. There's very little downside, in my opinion, to the uranium price at these levels, but just a heck of a lot of upside. And that's a unique situation in today's otherwise everything at an all-time high world.
Right. So are there any books or online resources that you would recommend for our listeners that want to learn more about this mining business and royalty business?
Well, I mean, first of all, there's a ton of great information out there. A mutual friend of ours, Miran Katusa, with his KatusaResearch.com, is a great source covering the resources. He's one of the biggest investors in the natural resource field. You can follow me on Twitter at Amir Adnani. I write about and tweet about gold, uranium, and mining-related topics and issues. Our four companies that we talked about here, Uranium Energy, goldroyalty.com, uraniumroyalty.com, goldmining.com, all very easy domain names to remember. A ton of information on our websites. The uranium price, if you're interested in that, just go to our website. We post it on uraniumenergy.com right at the top of the website. You can get the uranium price published daily there. And look, there's, as you know, a lot of newsletters out there that, depending on what your budget is and whether you want to spend more money on or not, you can subscribe to newsletters and you can get that kind of that type of service. But there's a whole world of it out there, and probably a good place to start are some of the sources that I mentioned.
Right. And so one last question to kind of ask you, so there obviously these mining industries go through these big boom bust cycles, and there are maybe young investors and or geologists out there that are thinking about this space. What advice could you offer them? Obviously, in a period like this where the industries have these lulls, what advice would you have for them in terms of getting into this business, or whether they should at all?
I think I'll just give you a stat. In uranium mining in the United States in the 1970s, there were close to 30,000 people employed in the uranium mining industry, and today there are 300, maybe 400 people employed in the entire uranium mining industry. I think if you're the type of individual who doesn't want to just go jump into a crowded space, a congested space, if you're a contrarian, if you want to be early to something, this is a time. Like, what a time to be part of an industry that's only 300 strong, but will absolutely have to grow in the coming years and decades. Uranium mining in the U.S. right now has the support of not only the bipartisan support of the United States government. The U.S. government today, for the first time since the 1950s, has announced initiatives to purchase uranium from U.S. mines, U.S.-based mines. This would mean new investment, new human capital, new energy has to enter the sector for the kind of growth that's expected to come about. Because again, we're back to the drawing board when it comes to asking ourselves about supply chains of everything. The pandemic kind of did that to us as well, right? We started wondering, holy crap, where do masks come from? Where do ventilators come from? Where do we get our pharmaceuticals from? And now the question is, when it comes to an important energy source, electricity from nuclear power, hey, where do we get our uranium from to power these nuclear reactors? Holy shit, we don't mine any of it. That's got to change. So there's bipartisan support for it. We're not going to be at 300 people in this industry over the next 10, 20 years. It's going to be back over 20, 30,000 people. There's incredible potential for jobs and long-term careers that are meaningful and exciting, and especially in the southwestern U.S. states. If you enjoy Wyoming and Arizona, Colorado, Utah, New Mexico, Texas, this is where the uranium kind of heartland is. And I think you probably have to have a bit of that contrarian bent to say this will be a big industry, and it has to. And for those reasons, I want to be in early. As an entrepreneur, that's how I've approached the uranium and gold sectors. It's been about acting as a contrarian and just being there with a long-term approach and developing these platforms. And look, you got to be patient when you do that.
Absolutely. Well, listen, Amir, thank you so much for joining us. It was a great interview. I'm hopefully this post-COVID world, the VRIC starts up again, and I have a wonderful reason to come back out into lovely Vancouver, and we can meet up again. But thank you so much for joining us. Any closing words or anything that you want to leave us with?
Really look forward to connecting with you in person. Yeah, I agree with you. Hopefully travel gets back to normal and these conferences open up, because they were a very important venue for people like yourself and I to connect, get to know each other. And so for anyone also listening who's interested in what we're talking about, or these industries that we're talking about, gold, uranium, copper, once these conferences that are focused on these industries open back up, I encourage you to make the time and travel to them, because a lot of it is there's a lot of information you pick up. You meet the people, you can keep in touch with them. And I agree with you, Patrick. It's a great thing to look forward to.
Oh, thank you very much. And have a great weekend, Amir.
You too. Thank you.
All right, thank you very much.
All right, Patrick. Or should I call you Lord of the Crayon? Crayons, not just crayon.
Yes,
crayons.
You got to get that right.
Because you use lots of colors when you're using your crayons. Talking charts, what do you have for us this week?
All right, well, let's just get to the top 3 things to watch next week first. We're not going to review last week's because we haven't done this for 3-4 weeks, but we're back to our normal schedule. So what I wanted to start off with is talking about the natural gas breakout. Now, I have here the continuous chart on nat gas, but that breakout is even more pronounced when you go to the front month actual futures contract. Here, we'll just look at these Julys. But this is a full-on bull breakout in nat gas. And the thing is that outside of the majority of commodities that are turning lower, and obviously oil and gasoline futures working a little higher, but nat gas is by far the one that's suddenly going parabolic. And so the question in my mind is this breakout just going to fizzle out after a quick pop like this, or is this an actual shift fundamentally in the trend? Because when you look at nat gas in the this is a weekly chart going out like a decade, and while the move looks big, I mean nat gas has just been bled out to these, it's just been left for dead. And this is the first time that this is starting to look like there's some real momentum behind it. What's your take on it?
Well, we didn't actually have a chance to prep before the show, and I'm a little upset because I think you're about to goocher my trade. I would have told you that you're not allowed to talk about this.
Talk about it. Oh
Yeah. No,
but you're long the strip, right?
I'm long the strip, meaning I'm long every month. I've been a big net gas for a long time, and even when we got into
well, congratulations.
Well, it's good to have someone against all your losers.
A really good show for you.
Yeah,
by
that's
making
right.
you brag about your paper profits.
No, don't worry. I have lots of bad trades on the other side to take advantage of, like my long steepeners that I got stuck with. And anyways. I'm a big believer in nat gas. I'm a big believer in energy in general. I think it's headed a lot higher, and I think it's going to be the stealth bull market. And it seems to be that everyone's given up on it. Nobody wants to own it. Nobody wants to have it on the sheets. And I think it's going to be the big winner.
Clearly, anyone who's looking at this chart would certainly have to have a different opinion. Anyway, let's quickly look at number 2. The jobs numbers coming out next week. Obviously, it's the first Friday of the month. Obviously, we had a huge jump in the jobs numbers late last year as the COVID pop and drop. But I mean, it's the numbers supposedly forecasted like 5.8%. But the number itself is not that important. Do you think it's a market mover? Do you think the jobs numbers matter anymore?
It is always, and it's important. There's no doubt about it. I can't remember. Is this one going to include any of the states that are no longer going to include the unemployment? Like, if I understand correctly, a lot of the states are making people go back into work. So we're going to get, meaning that they're not going to continue with the unemployment benefits. And so we're going to get some funky numbers. It's very difficult when things are in this much flux. It's kind of, let's just say, it takes a lot of courage to say, to forecast and say with any sort of certainty that this is going to be one way or the other. I still think, though, Patrick, on the whole, that the economy is going to continue to surprise, and I think that if anything, we're going to see numbers that shock all you deflationist bond bulls. That's my call.
All right. So number 1, I'm not going to comment on your comment, but number 1, I wanted to just kind of touch on this rotation to growth. Is it a new trend? So obviously since November, we've had a very distinct outperformance of anything cyclical, financial, all of the kind of reflation trade stuff has worked really well. Value's been running. And ever since the kind of Fed pivot, or whatever you want to call it, where the little bit of a hawkish tone appeared in their voice, the FANG stocks suddenly came back, and a bit of rotation started here. But that was a reaction. But my bigger question is, are we back to the trends that we saw over the last couple of years where suddenly the money flow goes back into these growth names, or is this just short-term noise? And that's one of the bigger puzzle pieces to solve. I don't know if I have too strong of a conviction. What's your opinion on this?
I do have a strong conviction. That it was the Fed's pivot wasn't nearly as dramatic as many of the market participants have interpreted it. The reality was that the inflation, the quote-unquote inflation trade, was very overextended. When you see the doomsday financial news websites, no longer telling everyone that they should buy bonds because we're going to collapse into a deflationary mess, and instead are talking about, Weimar-type hyperinflations, then, that was probably the time when I should have taken the trade off. But what I think has happened is that with the Fed's slight pivot, and it was a slight pivot, no doubt about it, that they threw the market a bone. And in doing so, they cleaned out this trade. I think that a lot of those overly aggressive hyperinflationistas are now out of this trade, and I think it's cleaner and it heads higher. I know, but Patrick, you're at heart a deflationist. You have the lacy you have the lacy behind picture poster on the wall in your bedroom.
In my bedroom.
Yeah. And let's just face it, that's your go-to stance, and I understand it. I respect your consistency.
All right, let's talk some markets. Let's throw some charts here. So let's start with the S&P 500, and we were obviously talking gamma pin and whether volatility come back, and well, the one thing that surely did happen was volatility did come back, both down and up. I mean, we had averaged 20 S&P point ranges day in and day out into the gamma pin, and suddenly we're legitimately whipping a couple hundred S&P points up and down. So like definitely the gamma pins lifted, but clearly the bulls prevailed. But the
can I jump in there though? Because the volatility
yes.
was just there for 2 days, 3 days maybe.
Yeah, but we have a distinct bull trend in the last 5. Like it was a Monday.
Right, but volatility's come right back in. Like go dial the VIX.
Yeah, well, dial in VIX as a 15 and change. But let's be realistic. I mean, this was a 150 S&P point swing, or 3.5% in 5 days. I mean, yeah, a chunk of it did happen in 1 day, but this is a clear directional move. And so that, to me, is a market that's not pinned.
I think there's still a lot of gamma that the dealers own up there. I've been keeping track of what Jem and the Brent from Spot Gamma are saying, and it seems to me that a lot of dealers are still long gamma up here. And to me, it feels like that we're going to get that grind higher that's going into expiry. Usually, it disappears in expiry, but there's some big positions that are still outstanding.
Yeah, but for me, the upside targets here are around 4,300 to 4,350. So we're literally a stone's throw away from some pretty substantial overhead resistance. So I don't think that this is going to go parabolic.
So I'm not trying to say that. I just think it grinds higher, and that we get more of this frustrating action.
Yeah, I think that at this stage, the path of least resistance is for us to tap 4,300. I don't know whether we'll make it all the way to 4,400, but I think somewhere just north of 4,300 is where some of the market will find resistance on there, and it's going to be a quiet summer, a start to the summer anyway, and then we're just going to have to really see whether this turns into something later in the summer.
Just quickly, I did a study about the VIX, Patrick, and there's a huge seasonality in terms of July. And I was kind of shocked, actually, in terms of now. Don't do the VIX; you got to do the VIX futures, and you have to make sure you account for the roll correctly and do all the work. But if you do it, you'll see that this is often July is a terrible month to own VIX, protection. And so to me, I'm going to stick to my plan, which has always been that I think it grinds higher into July. And I'll look into be buying cheap volatility late July. That's my plan, and I think that I'm more interested. I'm more interested in time. I'm more interested in time than price for me.
Right. And so what I wanted to just highlight on the NASDAQ was this has been where the trend has been in the last month. And obviously many of the FANG stocks have really come back to life, other than some of the former kind of FANG darlings like Netflix that can't get off the mat. But the majority, like Microsoft, Google, even Amazon, are back to their uptrends, which is weird because, not weird, but they have been dogging it for the most of the year. Right? Since 2021, the FANG stocks were in the doghouse. That's just not where the money was. And suddenly we're seeing the trend. And I know that you're already ready to write this off. I'm not. I'm going to take the other side of it. Like, I think that there's more on the upside of these FANG stocks in the short term. While I do believe that we're in a commodity bull market, and I do believe that there is some transitory inflation that can continue to emerge as you are going to do your little victory laps on the interim. But I still think that on the FANG stocks have started to move. Like, look at this little uptrend here on the FANGs. They're just accelerating here. I think that we can see more upside here on the most immediate short term on these FANG stocks.
Listen, I'm not going to disagree with you about the short term. I think that all you're showing to me, though, is the fact that even though lots of the hedge fund gurus and the aggressive traders talked about inflation not being transitory, I call BS on that. I think that they always thought it was transitory, and just like you, their kind of go-to stance is this deflationary, is owning bonds, is owning growth, and that's what they've gone and reverted back to at the first sign that they think the Fed is returned to old. And I think you're going to find that trade rolls over. I'll take the other side of that trade. Maybe you'll figure out a way to work that into the bet.
We're not going to be able to work in the bet because this is not a 1 week story. But
Okay.
like if at some point we wanted to make a 1 year bet, I'd be ready to play a game with you.
1
Like
year.
if-
So you think that the Fangs are going to outperform for the next year?
No, not Fangs. I'm talking about
NASDAQ?
Well, listen, we'll talk about it.
Because
Like,
I'm willing to bet you for the next year. I'll go anything that's longer than 6 months.
I'll tell you what. I wasn't prepared to make a bet today out there, but I think that maybe now that we're approaching sort of the middle of the summer, I think we should make a end of the year bet.
Okay.
Like we'll figure it out in the next.
We'll
week or two.
negotiate it ahead of time, and we'll make sure we get it to a level where we can do a stake, like a big one.
Yes.
A big one,
Yes.
or maybe
a
even
big
a market,
kahuna.
maybe
Even
a
a
market
Duke or
Huddle.
Duke.
Or
Even a Duke or Duke.
or a market Huddle menswear.
Oh, now we're talking.
Because I still have to come clean on that. So I better. It'd be nice.
Well,
if
yeah,
you,
now
it'd
you
be
might
nice
be
if
in
you
the
lost one too, because then we could do it together.
Yeah,
we could be like
okay.
Dumb and Dumber
All right.
together, which
Yeah,
is
that would be
basically
right.
like kind of like our show. It'd be very
Let's-
fitting. Okay,
It'd be
let's
very
go on. What else? You got?
What I wanted to touch on this momentum versus value factor, and now just showing that short-term low that came in, and really the cyclicals have been under pressure, right? I'm going to use the XME for the broader mining space, kind of turned over, and the XLF, which is the financials. They both turned over off the Fed. They're both bouncing in the last few days, and while I'm not ready to stick my neck out to say that the highs are in on those. But boy, one of the more interesting things when seeing a trend shift is once you get the bounce off of the initial sell cycle, is whether or not they can muster up a rally back to their highs. I mean, if all of these fail to make it back to their previous highs and make a lower high, then that usually is all you need as confirmation that some sort of a bigger distribution cycle and turn is in. And while you're already ready to kind of reclaim that that reflation trade is going to be back and you should be buying the dip, I think the jury's out in my mind. I want to see what the price action looks like here in the next week or two before I'm as bold as you on making a call like that.
So is that what Lacey whispers to you at night when you're staring at him? Okay.
Absolutely.
Okay. What else you got?
All right. Well, we got to talk about this dollar turn. I was going to put it in the top 3, but then I said Kevin will make too much fun of me. So.
See, you really want to put it in every week.
Every week. No, but what is interesting is like
It's how important it is and how we should all be watching it for next week.
So here's the like I kind of want to generalize this kind of let's just generalize it as the 90 to 94 range on the dollar index. We're right in the dead center of it, 92.
Okay.
And really the last year has been defined as a ping pong match back and forth, a dollar index. And, you know, while there was a very definitive breakup higher off of that low, to me, this isn't sufficient enough to call a trend change. It was just an incredibly oversold dollar that was ready for a little bit of a squeeze. Given a catalyst, some people hit the exit button, and it ripped higher. And arguably, the dollar, in my opinion, could easily still muster up a move to 93, 94 on the upside, and still not really be bullish. And so to me, that's why maybe putting on the top 3 things to watch this week maybe not that important. But I think that watching whether or not the buying that started a week ago on the dollar continues is going to be one of the interesting kind of observations to watch, because arguably that dollar strength is a headwind for a lot of commodities. Clearly not oil, but for the rest of the commodity market, it seems to be a headwind. And I think watching what it does next is important.
I think that your comments about it being a ping pong match is a perfect kind of analogy, and I don't see any change in the ping pong match.
Well, considering we're in the middle of the ping pong table right now, I don't think that the resolution will come in the next week or two.
And I think you're right, though, that when you say even if it goes to 93, it still is in a bear market. And it's not. That's not going to be the.
Maybe not a bear market, but it's certainly not in a bull market. Like it would. Like maybe we've transitioned into like a dead zone purgatory period where the dollar's consolidating in a range it's very comfortable in.
We can only hope, because then maybe it'll get off the top 3 list every week.
Let's talk about the asset that shall not be named.
Oh God, really?
And so what I was just going to highlight here was that some people on that we know, which shall not be named, chose to try to bottom fish.
Oh no, you mean Cuppy? He nailed it again. The guy is one of the greatest traders of all time. Like he really
What do
is.
you mean he nailed it at what 28?
He bought it at 29 and he sold it at 33 or 34. He was.
So he's already out.
Oh yeah,
thank God. All right, no,
like,
that's good. So
no.
this to me is nice and bearish. Okay, look, whatever. He's a trader.
No,
Congratulations.
listen, no, but
he clocked a fib retracement. Like that makes him the best trader in the world. I mean, he's good. He's good.
Listen,
anyway, I love the guy.
But he's awesome in terms of he buys when no one wants to buy. That morning that it got up and he said, "I'm buying it." The sentiment is so bad. It was that morning. I can't remember. Was it Monday morning? We woke up and everyone thought it was going to break. What is the big figure? They were going to break 30,000.
30,000.
Yeah. So everyone was talking. It's going 30,000. Everyone was bearish. Even Pomp and those guys. Even they were getting a little worried and stuff. Although Pomp keeps buying every dip, and if you're all in, how do you buy every dip?
Yeah, it's
I'm a little confused about that.
He's either leveraging up huge margin or he's talking shit.
I think to be true, we're kind of being facetious and poking fun at him, but I do believe that he's not one to tell you that you should be 100% crypto. But there are some people that say that they're 100% and then they still find ways to buy more. Anyways, the point is that Cuppy came in there that morning, really scary. There was no bids. It was looking like it was going to crack, and he stands in there and he says, "I'm a buyer." He was like,
"Look, he clipped it. Congratulations!"
Like the Trading Places guys. What are their names?
He can buy me another steak. He bought me a great Greek dinner down in Miami.
It was anyway. So he's one of the great. He's really honestly.
So he can make as much money on this shit as he wants, as long as he spends it buying me shit. I don't care.
Okay, but you obviously have a longer term view, and you're about to say something negative about crypto.
Yeah, no, this is
just so you know, send
the
hate mail to Patrick, not me this time.
Yeah. No. I'm identifying the candle trend, not about my view on. Okay, so let's go to crude oil quickly before I get in trouble.
No. Let's go back to Bitcoin. I'm
done. Look, crude oil.
What are you saying though about Bitcoin? You're just saying it's in a downtrend and it's looking not very good.
Whenever you get these bounces that roll over like this is still a very distributed market, and I would not be shocked if this continues down towards 20,000 in this trend. Now, can we quickly change the topic?
Sure.
In trouble.
Sure.
All right. So let's get to crude oil, which I kept kind of like, is it going to be able to keep this kind of momentum? And this thing just keeps ripping higher in this trend. Like, there's a couple of these little measure moves that are targeting $85. It's like I personally was skeptical. Like, look, I'm not short energy. But I've been lightening up on it, and yet this trend is clearly persistent. And what is interesting is it really defies the trend in almost the entire other commodity complex. Like when you look at the grains rolling over, copper rolling over, lumber rolling over, almost every other commodity has turned. But oil just is like marching to the beat of its own drum and don't give a shit.
Yep.
It's just like it's.
Listen, they're doing some crazy shit. They're trying to solve the problem. They're trying to solve climate change. One second. They're trying to solve it by getting rid of supply. That's what they're trying to do, Patrick.
Yeah.
So if you go and change supply without changing demand, what's going to happen? Obviously, demand will be a little less as prices go higher, but you're not really changing people's habits and how much energy they're using. So we're having a situation where they're cutting back on supply everywhere you see, and yet they're doing nothing about demand. And not only that, let's face it, China's growing, the rest of the world's growing. The COVID's looking better in terms of we're getting through with the vaccines and the numbers are going down. We're going to be hopefully back to normal soon. I don't know exactly. I'm going to get yelled at for this, but a lot of countries are headed the right way. Let's put it that way. And if you have a situation where you get an actual robust economy with them cutting back on supply, this $75 oil could be cheap, Patrick. It really could.
All right.
Like I've always you
now know where the bet is coming when we get to the skin.
Okay, yeah,
game.
but listen, that's a trading thing for 1 week. But Patrick, I have said this for how long now that oil is going to hit $100 this year. I've been
this
seeing,
year.
Yeah, but I've been seeing it for months now.
Yeah, you have. No,
Right,
I'm not, I remember
I've
that.
literally been saying it for months that the oil is going to hit $100. I still think it will. I
don't. I just not. In
I
your
know
camp.
you. I know you don't.
I look. No. But I'm not bearish oil. First of all, like let's just make sure. Like
No,
I'm
it's much different. I understand.
I'm just not as enthusiastic. Like I personally think in the $70-$80 range, there is plenty of resistance here that could cap the market for the top end. Of
I
the
think
year.
you just, with that show that you cheat on me with, you just listen to Art Berman and the rest of the inventory guys too much.
Okay. All right. So let's talk.
I love it how you change the subject so quickly at that point. You're just like, oh, come on, let's get to another topic.
Well, you know what? We do have a whole bunch of charts I want to cover.
Okay, I'm sorry.
I don't want to have a 30-minute debate on why I'm wrong.
Okay. Okay, let's go on.
All right, so let's talk gasoline here, which is interesting because, like we talked about earlier with nat gas, nat gas, gasoline, and oil, they're all confirming. All of these energy plays are running, and that's really divergent from what we're seeing in the rest of the commodity complex because copper has really been kind of distributive. Obviously, China's been talking this down, but it really looks like some sort of a turn has happened. Now, that doesn't make it bearish. I mean, maybe we could see $4 on the interim. Probably would end up being a big buy on dip, but definitely it's not participating in a bullish manner anymore. And then, like when you look at the grains, like wheat breaking almost to a fresh new month low. It really looks like corn is rolled right over, and the soybeans looks like it's Bitcoin. It's the grains have rolled over. Lumber, another 7.5% loss again today. It's down to the under 800.
I said some stuff about maybe bottom fishing on that, and I lost another finger. I have no fingers left. I've been working with my toes and lately my feet because I'm.
This is the classic Eiffel Tower formation, and you missed it.
Well, yeah.
Like the Eiffel Tower, you have to wait till it hits the actual concrete and goes splat before you go and pick up the dead carcass, right?
Yeah, I guess I just blew it. The lumber's looking terrible. I do have something I'd like to ask you, Patrick. Is that and I'm being serious here. I missed the corn, the wheat, and the soybeans. And you know me, I'm too stupid to figure out which one I should buy, so I buy all three when I buy them. And I played them for a little bit at one point, and then I gave up, and I watched this huge bull run. I'm tasking you with telling me when I can buy these things again, because I want to buy them again. I think that they are headed higher ultimately. I do not believe that this was
many of these kind of cycle turns often from a proportionality perspective, you can use as a basic rule of thumb, like unless there's a full-on liquidity event like the March COVID event, right? Usually, like if the length of the bull market advance, let's say in this case was 270 days, you can start your base case that it could easily be about half the amount of days for the correction. So if it's in a bull market, so you can more or less anticipate that this will be at least a 3 to 4 month correction, and that often gives half of the gains back.
Okay.
And so, if we get it into the late summer, trading down to 1,200 on the beans, you can start to entertain the idea that a bottom could be in is just like a base case. Like obviously the unfolding reality of how it develops will matter, but I think that's
that's a good. You need a starting point. It's a good starting
point, and I would leave it alone for another month or two and see where the dust settles, and then look for where the selling is no longer intense and divergent, and then you start pulling out the shopping cart and put some in your portfolio.
Well, that's good. And I'll let everyone know so that they know that it's headed lower and that we're going to enter.
Absolutely. You do tell me when you go long,
just like
so
lumber.
I can take the other side of the trade.
Exactly. You know what? I won't even know about. We should just get an account, Patrick, and we should have
just trade against each other.
Yeah, be at the same broker.
An OTC. Like we don't even need to think. Like we just go. Just like our skin in the game, we'll just do OTC settlement.
Actually, I got a really funny story about this. I'm going to save it. I'm going to save it for a summer.
Can't be that big.
But anyways, okay, keep going, Patrick. I'm sorry.
Go for it. What do you want to say?
Well, I was going to say I have a really funny story about a hedge fund and guru type trader that had a trader underneath him that he wasn't doing very well. And well, I'll just kind of tell the story. The long and short of it is that I won't say who it was, and because I believe this guy wouldn't want everyone to know which trader it was. But the long and short of it is that this trader wasn't hot. So what he would do was he would actually tell the order takers on the desk to not fill his orders, to just fill it against his own inventory. So he had this sub-portfolio manager that was trading, and he thought he was doing all these trades, and the reality was they were just journaling it between accounts, which I thought was the funniest thing in the world. It still makes me laugh. It's like, can you imagine you think you're trading and you're getting these fills, and you're just like, it's your boss filling you? Trying to save money because you're trading like such shit.
So awful. Just use you as a contrarian indicator.
I'm just kidding.
It's like the summer of George theory. It's
Yeah.
like you're gonna just do the exact opposite of whatever this trader is doing. It's all right. Anyway, I just wanted to touch on the yields, right? Like you were already bottom fishing that 30-year, the 5s 30s.
Yeah.
I don't know. Like, you know what? Like, it's very oversold. And I mean, you've you thought that was enough selling, but I don't know if it's over, buddy.
Of course, you don't think it's over. That's okay. I've kidded you enough. I gotta let you talk now. So keep going.
If we didn't have already a bond bet on this week, I think I would do it again.
But listen, you should do the bet that you feel best with.
No, I actually like the oil idea. I'm going to go oil. Anyway, I think that's enough for today. That's a good talking chart session. But yeah, it'll be interesting. We'll follow up next week and see how things have progressed.
Okay, so now we got This Week in Trading History is back. What do you have planned for us this week?
Well, I want to go back to June 22nd, 1775. Just after the American Revolutionary War began, the Continental Congress began issuing paper money, known as the Continental Currency, or Continentals. During the Revolution, Congress issued just over $241 million dollars worth of these Continental currency. It was the first federally issued paper money in America. The Continental dollar was based off the Spanish milled dollar, equivalent to 8 reals, a Spanish unit of the currency. And the event predicated the official birth of the United States, which was designed to help finance the American Revolution, beginning in 1776, and obviously concluded in 1783. But it was styled after the Pennsylvania Notes. The Continentals did not bear any interest. They were just the promises to pay the bearer in gold and silver denomination of the bill. However, the Continental Congress and the colonial states circulated these paper bills simultaneously to cover those war expenses, which was in part what contributed to the significant depreciation of the currency. To further undermine the Continental bill's value, Great Britain obviously wanted to kind of goocher it for them, launched a counterfeiting campaign. And the counterfeiting efforts were so successful enough to cause the Congress to have to recall certain issues of the bills. The counterfeit bills were also being printed in the colonies by those loyal to the crown in an attempt to destabilize the struggling young economy. The depreciation of this continental currency was so severe that by January 1781, it took 100 of these Continentals to purchase $1 of hard money, which is like gold or silver coins. These factors undoubtedly the reason behind the phrase "not worth a Continental." And so the painful experience of runaway inflation and collapse of this dollar prompted the delegates of the Constitutional Convention to include the gold and silver clause in the United States Constitution, so that the individual states could not issue bills of credit or make any thing but gold or silver the tender of payment of debts. However, it was in the Supreme Court judgment that it was obviously a big heated debate as to whether the federal government could issue its own currency versus states. But the ruling in the end was that while individual states could not issue that was not the case for Congress and in terms of their powers. And so, nonetheless, the continental currency was the first decimal currency in the Americas. It is a testimony of the early efforts to establish a viable monetary system that ended a complete disaster.
I like how that is. Complete disaster. Complete disaster.
Yeah. Oh. Anyway, but that's the first attempt at fiat money. And it didn't turn out. But you know what? The key to fiat money is that everyone's got to have no alternative.
Bitcoin solves
Too big
this.
to fail.
Bitcoin solves this.
It always does.
Yeah.
All right.
Okay, so let's go on to the next thing here. Skin in the game. So I did another chump move.
Well, because hindsight's 2020.
No. But
first of all, you messed up because you had no business putting it in such a tight range. If you just look at the daily volatility of the freaking long bond.
Patrick, if I had done a non-future, because let's face it, let's tell everyone what happened. I came out on Friday and I thought the bond rally was over. So I tried to do a one touch on Patrick, and for some reason, like a complete chump, I decided it was better to do in the future, which makes no sense. I should have done it on the
futures.
I know, but I should have done it on the TL. I should have done it on the TLT because it is exactly that, because like TLT is not really what I trade, and that's not what I'm watching. So I did it on the futures. But the thing is, Sunday night. Yeah. When Patrick and all of his deflationary buddies got together and got worried about everything,
we cornered it.
They set the bond market straight up, and literally, I lost my bet before the market even opened on Monday. That's how bad it was. I had to tell Lena, "Don't do the Twitter thing because I've already lost." That's how bad it was. Okay, but the ironic thing is that by 9 or 8 o'clock, by the time New York opened, it was below the one touch, and it never saw that again. So I was a complete and utter chump for trading that, and I should have gone, and if I had done TLT, I would have won. But a bet's a bet, and you won. Good for you. You nailed it. You did it great. I wonder how many bond futures you bought that night to get it. But
our
that's
listeners are hearing you talk about how you shoulda, coulda, woulda. Because in trading, we never have regrets or hindsight.
You know what? My favorite line that I always use is that basically something to the effect that at one point my grandmother tells me that she was once quite a dish. That might be great and it might be true, but it's not doing anything for me today. Anyway, right. So let's just get on with the new. I have to tell people about this, right? About our thing. Okay, Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, 2-4, a bottle of wine with a $100 limit, and then the big kahuna, the steak dinner. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. So I lost this one, so that means that you, as the winner, have to come up with another bet. So what do you have for us?
August oil contract, baby.
Okay.
You are so bullish that I just want. I'm gonna just feel how bullish you are.
Okay.
So we're just gonna go over under 75.
75?
Friday. Yeah.
Oh, I'm taking under. That's not. I'm like
you're taking the under.
Yeah, too bad.
I thought you were bullish.
I am, but
so basically, you're so bullish that almost all of our listeners went and bought crude oil because of your silly rant. And now I go $1 higher than the price of oil, and no, I'm taking the downside of this.
I'm taking the downside. Too bad. So let's do it. Oh, sorry.
I'm doing a Duke and Duke with you. Forget
Oh,
this.
you're such a.
I don't want.
We have to do pictures. We get a.
No. You
Okay.
you know what? We have not offered any respect to the Duke and Duke bet, which is a very noble bet.
Okay, that's fine.
And you know what? This is, I think, since you decided to chicken out of the trade.
I'm not chicking out of the
ready.
trade. I'm taking my side. Like you put too much on it. Like you put too much juice.
$1.
$1.
It closed at 74.
Yeah,
$1
you put
for a whole week. If you were bullish, that's an easy thing.
Yeah,
It's
but
like a
why would
one-day
I?
move.
But like I can buy it in the open market, $1 lower. Why would I do it there?
All right, Duke and Duke it is, $1.
Okay. Well, there
All
you
right,
go.
That's
a disappointing- yeah, that is a wah
Lena,
wah.
put that wah music inside here. Just everyone.
Oh,
All
jeez.
right. It's time for the no stupid questions.
Oh yeah, and so these I am going blind on these. I do not know.
Yeah, you have not prepped, but I think that
I don't know if
it's
it
easier
helps.
for you to have a stupid answer. No,
Yeah.
it might be easier to have a stupid answer when you don't know what's about to come. So
Okay, let's go.
Lena, are you there?
Yeah, I'm here.
Hey, how are you, Lena?
I'm good.
All right, let's do this.
Okay, so first question this week. Hi all. When do market makers hedge their positions? At the end of each day pre-market or as they put on positions? I was always under the impression they put on their hedge as soon as they open the position, but I really have no idea. Does it ever change? For instance, do they need to hedge their short Tesla calls more often than SPY calls? Thanks.
All right, you go for it, buddy.
Okay, that's a great question, by the way. So when do the market makers hedge their position? And listen, we're going to speak in generalities. Every market maker might be slightly different, and they might have different rules and different procedures. But I'm going to speak in generalities. For market makers, they always hedge when they initially put on the position. Generally, what happens is that they'll go and they'll sell. Let's say they sell 1,000, S&P calls. They'll go buy 500 futures or whatever the equivalent is immediately. They take care of the delta right away. And then often when you're dealing with institutions, the institutions will set up the delta side of the trade alongside the actual option trade. So they'll either supply it or they'll go and get the main desk to supply it because the market makers don't want to take the outright risk. Now, when it comes to going and trading, let's just say a market maker that's making markets in Teslas and they're going back and forth and they're trading flow back and forth, they might, if someone comes in for a 10 lot and they say, well, my, let's say, threshold to hedge is 1,000 shares, they might not hedge that because the reality is that 10 lot probably has a delta that's less than 1, and it does have a delta that's less than 1, and therefore it will be less than their hedging, so they might aggregate trades back and forth just so that they're not crossing the bid-offer spread all the time. But when it comes to size, they will make sure that they hedge it right away because they're not in the business of trying to make money off of the direction of the stock. They're trying to make money off of, forecasting the volatility of the stock or taking advantage of mispricing between different strikes and different expiries and hedging those things out. That is not their goal, is to be delta traders. So they will generally not do it. And in terms of your question, what time of day do they... So that's for the initial trade. Then there's the hedging that they have to do continuously as the stock moves based upon their gamma. And also more than just their gamma, they also have the issue with what they call delta decay, which is charm, or even Vanna, which is the amount that their delta changes as volatility moves up and down. So this is our buddy Jem Carson has talked about this extensively. When we go and look at the big market makers that are making markets in the S&P 500, like the grand kahuna of all the option pits, they have 3 periods that they kind of readjust their book. And they do it on European Open, which is 3:30ish in the morning for us here in Eastern time zone. Then they do it again once the U.S. market opens, so that's anywhere between 9:30 and 10. And then they do it again towards the bell. And so if you ever see a situation where, all of a sudden there's this strange bid at, let's say, 945, and you're like, where is that coming from? Sometimes that's what's known as the charm bid, which is the delta decay, which are the market makers buying back their positions because of this decay in the overnight, and they have to, they're short more futures, and just because of the way it works. Anyway, so that's that. And in terms of, do they ever hedge their gamma more frequently? I don't know this for a fact, but I'm assuming that they do, because the reality is that many of them will go and have absolute limits of how much delta they'll do before they hedge. So meaning that they might say, I'll let my gamma run up to X dollars, and therefore at X dollars of positions of deltas, I will hedge, as opposed to waiting for specific times. And therefore, when you get a stock that's moving around more, they'll be hedging more often. So I hope that answers your questions.
I think that's pretty good. All right, Lena, what's next?
Hi, everyone. Is your risk tolerance the same for all the colors of the markets? Examples: portfolio drawdowns, sectors, business risk, trade times, etc. Are risk tolerances born or created? Cheers. And P.S. There's probably a double rainbow metaphor somewhere in there. This is what this listener is referring to as a double rainbow song on YouTube. It's the first thing you'll find. You'll have a kick at listening to that.
Actually, I've heard about this double rainbow thing.
You got to listen to it.
Watched
It's hilarious.
It's funny.
Yeah,
Oh my God, it's hilarious.
People should Google it. The double rainbow. I've heard about this.
PSS, I mean, it's too obvious. Satoshi until mid-2010, double rainbow 2010, Bitcoin 2011.
Oh.
Okay, I don't know what that means.
I see the connection.
I don't see
Okay,
anything.
so anyway.
I don't understand that connection, but I don't understand most things about crypto, so I'm par for the course.
So in terms of risk tolerance here, Kev, I think that you're going to have your perspective on this, but I would imagine, at least from what I'm interpreting, the way I look at it is about, how do you manage risk, or how do you size risk in terms of the different aspects of the market? Because I so regularly use options, risk is often defined by how much hedge you buy or how you put on the trade. And because implied volatilities change between different asset classes based on risk, the size of your trade will also adapt based on it. So if you're trading something with much higher implieds, naturally your position size will be much smaller by that. And so for me, the sizing my risk, sizing each trade will be very dependent on the volatility of the underlying, which will naturally size it for me. That's the way it works for me. But how do you approach it?
Well, I think there's a lot of different elements of this. One of the easiest things to kind of just respond is that everybody is different, and one of the questions is, are risk tolerances born or created? I do think that to some extent that they are born. There are some people that are just willing to take more risks, and that's just the way they live their lives. And then there's others that find that they've tried it. Like, I know traders that have tried to have been instructed to take more risk and have gone and introduced more risk into their portfolios, and they just can't do it. It just doesn't feel good to them. They find that they don't think as straight, and they don't trade as well. And so the reality is that trader is better off trading less size. The other thing I would kind of say is that not only are your risk tolerances based upon individual personalities, they're also dependent on your time of life and your financial situation, and a whole variety of different things like that. I remember there was one fellow on Market Wizards. I can't remember what it might have been. Tom Baldwin. It was one of the bond traders, and he literally, quit his job, had a new baby at home, and went to the pit to trade his own account. And he ended up being a great trader and did well. But wow, I don't know how he could do that, because the reality is that with a new baby at home and the fact that you have to make money, it ends up being much more difficult to do it. So to me, there's also an element of not only is there an element of how you personally perceive risk, just versus others, but there's then also the element of how you perceive risk at your different stages of your life and your different stages of your financial, career or situation. I know for me, the moment that I need money, meaning that I need to make money, like trading, it becomes it's way harder for me, way harder. Yeah. And I do much better when, like, it's almost like if I don't care, I can make it just kind of like that. It's like when you used to go.
Truism for you, buddy.
Yeah, it's like when you go picking up, the opposite sex at a bar. The more you seem to try, the worse you end up being. Like, if you're just kind of casual about it and more and relaxed, it does better. Right,
the more you try, and the harder you try, the harder it is.
Yeah,
it's the weirdest phenomenon in trading.
Anyways, I hope that answers the questions. There's lots more. That's obviously a very huge topic that we could talk ages on.
All right, Lena, next.
The last question for this week. If I can trade within my IRA account without paying taxes on the trade, why would I not just trade in and out of dividend stocks when they are near their dividend distribution? This would allow me to snipe the dividends of a ton of different stocks, right?
Do you want to do it, Patrick?
So I just grabbed BCE, the chart right here. So just as an example of a high dividend paying stock, paid an 88-cent dividend back on June 14th. The stock immediately reflects it with the drop. So notice that it closed at $61 and let's say 68 cents, immediately opens the next day at $60.76. It literally, the stock immediately drops to reflect that dividend. And so the ability for one to just snipe dividends out of the market, it's baked in. And it's not only that, it's baked into the options market too. And so, like, if you try to collar in a stock by buying an at-the-money protective put and sell a covered call, the dividend is being discounted into the option pricing model, which basically removes the arbitrage of it. It's basically, there's no advantage to doing this. It's already been baked in the cake. Do you have any
the only comment I would make is that I don't know American tax situations, but here in Canada, dividends are taxed more advantageously,
No, but you're talking about like in a tax.
No, I understand, but my point is that therefore people overpay for dividends because of their tax advantage, and therefore it not only is this trade not good in terms of it not working because the market bakes it in. People often try to figure out ways to collect dividends, so they overpay for them outside of their,
but make net money,
right?
Because
of the tax situation. So it ends up being that doing this in a non-taxable account is even worse because there's people trying to do it from another perspective. Anyway, it's just something to think about. I don't know how it works in terms of in the U.S., but the market is efficient and there is no easy magic silver bullet.
There you go. All right, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right.
Okay.
That's a wrap.
Right. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on the Market Huddle on Twitter. Lena gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And if you could, please give us a rate on iTunes. It's a dumb game, but it would really help us out immensely. I almost stumbled on that word, Patrick. Where can they find you?
You can find me at Patrick Ceresna on Twitter, or you can follow me at bigpicturetrading.com. Kev, where can they find your fantastic newsletter?
You always make me laugh about that. I'm on Twitter, first of all, at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Well, there you go. That's a wrap.
Okay, so let's do the beers. And I got out of this, so I.
Lena, you're drinking this with me, right? I'm not alone.
It's good if you chug it.
Are we gonna get 2 under 5s? That's what I'm looking for.
Well, you know what? The name of the beer is Dirty Little Freaks. I think you could just stop with the word dirty. You don't even have to add the rest of the words.
It's actually a good name.
It smells really nice, and it makes me feel like I'm about to drink one of those fancy ice drinks from Starbucks.
Yeah.
You know, those like crazy
this
concoction of coffee. And then you drink it and you're like, oh, wait, it's not coffee, it's beer. So
It's just bad. Okay,
Yeah,
so
this is
drum roll,
Baltimore
please.
beer.
What's the numbers?
Lena, you want to go first?
I should go first.
Sure.
I didn't hate it since I chugged it. I give this a 6.2.
6.2. That's a low one for Lena because
Yeah, that's a
Lena
low
is
one for me.
like, let's face it, Lena is a very kind individual compared to Patrick and myself.
Yeah.
I have to say that, by the way, because otherwise Lena's going to leave in all my edits.
Oh my God, no.
We'll talk about that in a second.
talk about
Patrick,
that.
Patrick, go ahead and tell us.
And then-
the beer.
And
beer
then
number.
for me, I'll give it a 5.5. Like,
Oh, there
this
you go.
is
Okay.
a beer that I will never drink again.
Okay.
You know, I'm sorry to the brewing company, but you got to do better.
Well,
than
listen,
this.
great name though. Hats off to you. Great name.
Duclaw.
Yeah.
In Baltimore. You know what? We have a few more American beers to feature in the coming weeks because Lena and I are back from Miami. The piss up was great. Cuppy was so much fun.
Yeah.
It was great, but now we're in Canadian purgatory prison of freaking the 14 days of you're not allowed to even look outside your window because someone might get COVID from that.
So Patrick, I don't know, like, you shouldn't go away. I mean, I guess I should have come with you guys because this is what happens when I don't come with you. Lena leaves in all my bad edits.
Oh my God, that wasn't
I love that.
intentional. I was in such a hurry because we were leaving
It's
first thing
okay.
in the morning on Saturday. I felt so bad.
It was pretty funny though because our buddy there that we did it out, Rupert, he was like, "What did you do to piss off Lena? Because she's trolling you bad, buddy." And I was like, oh, and I tried to remember, and like sometimes
But there was a second one because it was also in the intro to Will.
oh, did I fuck it up twice?
No, you didn't fuck it up. She just cut out the
Yeah,
entire
I
intro.
fucked it up. This was my fault.
Yeah, like
Oh, okay.
It's all my
it basically went straight to Will without an intro to Will.
But like, listen, people got to see the sausage being made, and it was not pretty. It just was not pretty. Listen, folks, I'm not always that bad. It was because like I literally a lot of times I just like wing it, and it's the first take, and that's not But if I am gonna screw up, it is the intro. That is kind of my like starting it, getting it going, the flow
That's usually
going.
the only time. you screw
Yeah,
up.
and
You
then
never
that's
screw
and
up.
well, because the reality is that when there's a problem in the middle, we just leave it because it's kind of funny, and usually we're getting going there, and the other thing is it's an easier fix at the beginning, so there's almost no work because you just started at a different spot. So we're a little more. If we don't get it perfect the first time, sometimes we do it again. But
And then I
sometimes
just
it's comedy gold, and like this time, it's just comedy gold, so people got to see it. So I'm not sure how many people got it because you did fix it eventually. So I got some people.
no, actually, no, because it didn't upload properly. I was listening to the podcast.
Oh, so that's great. Great.
That's
Yeah,
not
so
true.
no,
I
everyone. Oh, yeah.
Did you
Yeah.
flush the cache like
maybe
you had to?
once I
Yeah.
downloaded it, cached it or something.
Oh,
But
well,
anyway,
that's it.
some people got the first version and some people got the second version.
Anyway, so that's it.
I
So
fucked
I
up.
looked.
Sorry.
It's all right. No, you don't need to worry about it. You work hard all the time, and it's
you-
my
you-
fault for screwing up at the beginning. If I had done it properly, I wouldn't have had any issues. And for
So
those,
you're out of province, aren't you, Kev?
yeah. So
Oh,
I am
yes.
in the bed Provence. I'm in. We decided to actually go on our first little mini vacation in a long, long time. So we took off to.
Do you have the double jab?
Actually, I did get my double jab, and I'm good. No issues at all. Like
So-
I don't know. Like
Did you get the double jab of the AZ or
no, I'm Frankenstein.
You're mixing.
I'm
You got
mixing.
the cocktail?
I got
Vaccine
the
cocktail?
I got the cocktail. And you know what? It was a shock. We went. I went to
Which one you get, Pfizer or Moderna?
Pfizer. I couldn't believe how efficient it was. We went to the Seneca College near Fairview, and it was. I
you
got
were
there,
in and out.
I was just like, I felt like it was. Well, it was so well done. I was so happy and so pleased. And anyways, yeah. So it just boom, boom, boom. I'm all done. Actually, the only difference is when you have the AZ first. And did you say AZ, Patrick?
Yeah, like this AstraZeneca.
He just got back from Miami.
I know.
Yeah.
Jeez. When you get the AZ first, they make you talk to Patrick. If you're going to do it, they make you talk to a doctor if you want the Pfizer because they want to make sure you understand that you understand that you're mixing.
What
Yeah,
are the?
I'm-
What
I've-
are the?
I
risks?
decided
It's kind of
I'm-
like when
I'm
you're
just gonna-
mixing your party drugs, and
You know what? I decided I'm not mixing, so I booked. So as soon as I get off of this 14-day prison sentence, I'm gonna basically. I booked my second jab at a fucking grocery store.
Nice. Costco the first time. Costco
No,
the
so-
first
yeah,
time,
and-
and Loblaws
yeah,
the second.
and-
It's
Yeah,
golden.
exactly. No, Sobeys this time. But,
Sobeys, okay.
But I'm going to do the double AstraZeneca. That way, when I contract some sort of like side effects, I can deliberately blame only one company.
Oh yeah,
Like,
yeah.
when you-
Keep
so
it this smart.
so
You're smart.
Like
Smart.
right? Like
Yeah.
right now,
You're playing the long
something
game. I
happens-
like it.
Yeah, like I want to know that I can blame someone for fucking me up, right? Like it's better
Patrick,
for lawsuits.
it's
and
a-
stuff.
you know what? There's that long past the point where you can do that. Okay, so I got something new to talk about that I want to talk in a TV show, but it's not a TV show. You know, we always talk about different things we're watching or doing. I got an Audible, and I got it, I guess, a week ago. And it started with, so there's this guy named Bob Leffett. I don't know how to say his name. You know, I'm probably making an embarrassment of myself. He's like this rock guy from L.A. Lefsetz. I don't know how to say it. It's Lefsetz. And it's the Bob Leffett's letter. He writes this kind of blog. And I've been reading it for a long time. Barry Ritzel turned me on to it. And he started talking about this book that he said was the greatest fictional book about rock and roll that he's ever read. And it's like the Revel of Opie and something or other. I bought it. It was crap. And I was like, oh, God, Bob, you sent me like, Pat, you really kind of messed that up. And then he talked about, and he said, but, and everyone, I know about Daisy and the Six, and this one's better than Daisy and the Six. And I thought, okay, well, I didn't like the one that he likes. I'm going to try this Daisy and the Six one. I got this book. This is the best thing I've heard in ages. Lena, do you like listening to Audible, by the way?
Oh, yeah.
Okay,
Yeah,
this
I
one,
listen to
first of all, is this woman who wrote this book, and it's loosely based upon Fleetwood Mac. What's the lead singer in Fleetwood Mac? The lady.
Oh my God.
We're making
Stevie
our-
Nicks?
Stevie Nicks. So it's loosely based on Stevie Nicks, but it's just it's historical fiction. It's completely made up, but it's based around the same time and the same thing. But the interesting thing about the technique of writing, it's just a series of interviews of everyone in the band, and
But it's
it goes.
fictional.
Yeah, but it's fictional. But it goes from one very quickly from one band member to the other, and you'll see different how they interpret things differently. But the great thing about the Audible is that they got a different actor for each voice,
Oh.
and
that's
it's
nice.
like more of a
That's nice
production. And it is.
Yeah.
Listen, I can't say enough great things about this. I think it's the best thing since Loudermilk.
Sorry,
And-
what is this called?
It's called Daisy Jones and the Six, I think. Let me just double check. And my wife read it, and she didn't like it as much as me, but she read it, and I'm thinking maybe it's better as an Audible.
Probably.
And then the interesting thing about it is that Reese Witherspoon's production company picked it up, and it's going to be put into a 13-part series.
Oh,
Nice.
on HBO, Netflix.
I don't know. She does HBO's, doesn't she? Because I think that like Little Lies is an HBO, and I think that was her.
Yeah, I think it's
So
on HBO.
if you're an Audible fan and you like listening to books and you have any interest in a rock thing, and then not only that, you're willing to step outside the traditional way the books are written, this thing is outstanding. Like I honestly, this is just so good. I love it. I look forward to going to bed so I can listen to the rest of it.
Oh.
Yeah, it's that good.
I'm gonna have to listen to it because I just finished a book too.
Okay.
On Audible, so I needed a new book to listen
Yeah,
to.
and listen, I find LA kind of fascinating, especially that time and the gritty kind of that whole scene, and I love it. And oh, Patrick, I know.
We're talking about books.
Yeah,
He doesn't want to read them. He doesn't want to listen to them.
He also,
Sorry,
Patrick doesn't also
yes,
go to
back,
that coast.
back.
I like the West Coast better. But anyway, so for me, I'm a huge fan. I thought it was terrific. Check it out, people. Let me know if anyone disagrees with me and thinks it's not as good. And I can't wait for the actual production of the TV show because I think it's going to be awesome. Awesome.
All right, I'll have to check it out.
Okay, how about you guys? Do you guys watch and do anything interesting? You guys are in purgatory. You must have something new you're watching.
Nothing, but I got a call from our quarantine officer.
Yes,
Oh.
I did too.
Oh yeah, well,
That's what I look forward to. I just sit by my phone. I just stare at the wall. My 14-day prison sentence, waiting for my phone call, them checking up to remind me why I'm on a 14-day prison sentence.
is it a computer or do you get a person?
No, it's a real
Oh no,
person.
a person.
Oh, that's good.
It's a real person. I forgot to answer it the first time because it was like a 188 number or whatever.
Yeah.
And then I realized it was, Government of Canada quarantine officer calling. And I was like, oh, shit, is this going to get me in trouble? And then sure enough, they called right back at the same time the next day. And I made sure to answer.
Our American listeners right now are like, what the hell's going on up there?
Exactly.
You guys are fucking crazy.
Hey, but our team, we have a team in the Stanley Cup Finals. And it's for those who don't know, it's been since 1993 since a Canadian team has won the Stanley Cup.
Oh, my goodness.
Okay, so we have the Montreal,
And I couldn't think of a worse possible Canadian team to be there.
God, Patrick, you're such a Torontonian. Listen.
No, it's not about Montrealers are great. It's just like my brother-in-law is like a diehard fan, and I'm
Montrealers are great, but the
shirt.
Hab fans are idiots. Is that what you're saying?
Oh yeah, no, exactly. And the amount of pain and flack I'm suffering having to listen to this on an ongoing basis.
I am happy.
You're gonna get some hate mail now.
I want them to win. I always root for the Canadian team. And I'm so excited that they're in the finals. I hope they win. I hope Carey Price gets his Stanley Cup. He deserves it. I think it'd be terrific. It'd be the greatest thing ever. And hopefully Montreal doesn't burn down their city if they win.
I was gonna say, are there gonna be riots in Montreal? Jeez.
I'm gonna make sure I'm out of the province by then.
Yeah.
Yeah, you do not want to be in Montreal if they win a cup. Like, there's going to be like fires and.
The only reason that we, because Montreal had trouble, and I think Vancouver had trouble with riots, and the only reason that we know that we don't know about Toronto is because we haven't won in since 19.
Forever.
Oh, come on. The Raptors won.
I know, but that's different. Those fans are nicer than the Leaf fans. 19. When was the last time the Leafs won, Patrick?
67.
Bill Burackle when they found his body. Yeah, I think it was a Maple Leafs Stanley Cup. I think it's been a long time.
It was pre-inflation period.
1967.
Like, think about it. Like, we talk about how like there's like no money managers that lived through there's handfuls left that lived through the 1970s.
Yeah,
and you have to think. The Leafs won the cup.
That's how long ago it was.
That's
before inflation was a thing. All right. We were still in some disinflationary cycle before inflation kicked in. That's when the Leafs won.
So, I was talking about this, and someone told me that what's even worse is that the English have not won the World Cup since then, too. They're worse than the Leafs. Let's just look at this. When was the last time...
How are they doing
English.
in the Euro Cup right now?
They're doing well, and you know what? I heard that, and I was like, and I saw that they were,
You're just
favored.
butchering it for them right now.
No. I opened up all the betting with my desk. I said I'll take England against anybody even up, and people actually took me on some, so I have some exposure.
So you've got a betting book going now?
Yeah.
Did you at least get
English
the proper odds, or did you go 1 for 1?
No, that's what I said. That's what I just said. Because people give away way too much when it comes to betting on their teams, like nationality, because they're so excited that they can bet on them. So they'll be like, I don't care about the odds. I just want to bet on whatever, right? Whatever, country, and I don't want to say a country. I have a bunch of them, but let's just see. When was the last time the English won what is it called? The World Cup? Have I got it right?
No, this is the Euro Cup.
No, this is the Euro Cup. I want to know, though, the
the
last time that they won the actual world.
So I'm in a Euro Cup pool, and I fucked mine up because I did the same thing. I was betting on teams I had no business betting on because of...
because you like teams, right? You like a certain team, and then you're like...
I just couldn't play the unbiased thing. That's
Well, that's like we told maybe we should tell that story sometime in the summer. My famous NCAA basketball, where I would make market.
Cool,
and I would just March Madness, and I didn't
thing.
know a thing about basketball. I still don't know a thing about basketball.
And you fucking made.
Okay, wait, yeah. No, you know what? I'm wrong. They won it in 1996. It looks like. No, that's 1966. My dyslexia is kicking in. So yeah, they're worse than the Leafs.
96. No, 66. Damn.
It's okay. I don't deal with numbers for a living or anything. It's okay.
No, yeah, you're lucky. I'm like that too.
yeah.
Lucky,
Well, anyway,
lucky
so
you don't
England,
use
I'd
math.
love
get
to
a
see
trade.
the English win because I think it's going to be the English and the Maple Leafs in the same year. That's what I'm calling for.
Wow.
What's that? 2 years from now? 2 years from now. I'm calling it right now. It's going to be double. It's going to be two of them are going to go.
The English are going to win the World Cup, you're saying?
Yeah, the World Cup.
Wow.
2 years from now. That's my prediction. Because I think they have a good young team. I don't know anything about it. I got flack the other day because I called in this podcast. Oh, I remember it was Diego. It was talking about different positions, and I called and
Goaltender.
no goaltender. And at least I didn't call the forwards like right wing and left wing. Like I did pretty good. I knew striker. Anyway, so yeah, I just I feel like soccer is not really something that we Canadians are that good at. So I get a pass.
I think you get a pass.
I get a pass.
Yeah,
Okay.
you get a
Well, anyways, listen. I should go because my family wants
Yeah.
to go do some stuff. They got a big night.
That was a good show. We'll be back to our regular format next week. I like it.
Okay. Take care, everyone. Thanks for tuning in.
All right, take care.
Bye bye.
Cheers.